I don't. I don't blame you if you're out in the garden and enjoying some ice cream or going for a walk. But I've got nothing to say today because today's coffee break is being hosted by Amelie. Amelie, thank you, and our guest speaker is Ula. So I'm going to put myself on mute, shut up, listen and learn. Hand over to Amelie. Take it away, Amelie.
Just quickly as well, as always, if anyone mentions anything personal relating to their own financial position, I will cut it out the recording at the end. So don't let that put you off contributing to the session, okay?
Brilliant. Thank you so much, Mark and Katie, for having us today. So I'm Amélie Chaona. I've been a member of E2W since mid-2020, so almost a couple of years now. I'm really passionate about personal finance, or as I call it, financial well-being, with a specific angle on women, because I think there's a lot more we need to do in that space. So I started the financial well-being sessions, I think probably about 18 months ago. So we've had a few, but we haven't had one on investing, which is probably by far the most important aspect around financial well-being and accumulating wealth. And it's particularly relevant to have this session right now, because as we all know, inflation is going absolutely through the roof in the UK. So now you need to make your money work twice as hard, or maybe 3 times as hard as you used to in the past. So investing is absolutely fundamental. And we've invited the wonderful Ula Caroto with us today, who will talk you through some basics, and it's a bit of a refresher, basics around investing in traditional instruments. But without further ado, I will hand over to Ula for her to introduce herself and start the session. But actually, before we get started, I think it's okay to interrupt us and let the session be interactive. It is not, it's not a masterclass. We want this to be a workshop, so please feel free to interrupt. Thank you all. Over to you, Ula.
Great, thanks very much, Amelie. And yes, I very much agree with Amelie. Please do interrupt me and us at any point you have any questions or comments. So for those who haven't met me, I'm Ula Caroto, and I am a client advisor at UBS, working with wealthy individuals and helping them create wealth plans that serve them now and into the future. My clients span across entrepreneurs, corporate executives, and also wealthy families, which I have alluded to. I've been in the industry for almost 15 years, and during the time I have been increasingly focusing on bringing more women to the financial and investment conversations. And I want more women to be able to take control of their finances and wealth, so that we all can be more financially confident and secure. I also feel very passionate about helping women on their financial journeys. And in addition to doing that in my day-to-day role, I also try to do it outside of work as well. So I've taken part in a hackathon during which we explored and investigated how we can get more women into investing. And I also invest in female-led businesses and encourage financial conversations in my personal and professional networks. So I'm really delighted to be here during the session here and talking with you about your financial journeys. And you know what? Whether talking with my clients or women in my network, such as yourselves, and even even though investment knowledge spans from zero to level way out of my depth, when I think about it, regardless of how much wealth we have and how much knowledge we have, we all want our future objectives to be met, to have a comfortable and secure lifestyle, and to have good retirement, and many more of needs that we want to be met. And so this is why I put together a financial confidence survey to really get you thinking about some of the topics that are very important parts of anyone's financial journey. So thank you very much for completing the survey. If you have, if you haven't, I highly recommend having a look at it. Excuse me, it shouldn't take more than 5 minutes, but it really will get you, as I said, starting to think about perhaps where you are, where you would like to be, and perhaps provide a nice starting point. So perhaps before we go into investment refresher, I wanted to start a little bit on the wealth journey, and especially on the wealth journey that women take, which quite often is slightly different to those of men. And before that, I do have to make a disclaimer, which I will read out, that none of what we're going to be talking about, and none of what's included in the presentation I'm going to share with you should be seen as recommendations, investment recommendations, or recommendations to use my services. So this is purely for educational purposes. So, thank you very much for sharing, Katie. So, as I mentioned, it's perhaps we can do a bit of an icebreaker. And if I could ask you to share in the chat, or perhaps by coming off mute, it would be great if you could share something you feel positive about in relation to your own financial journey. So, for example, for me, if it makes it easier, if I was to start, this month I had an update on how much I'm going to contribute to my pension, and I increased it by a big whole 1%. So my annual pension contributions have increased marginally, but as we know, compounding effects over time have a positive impact on that. Would anyone else like to share their positive in relation to their financial journeys?
Yeah, I'm happy to share something. So I actually did manage to do my tax return yesterday, which is a record, given that normally I do it on the last week of January, and I've managed to offset my tax bill through investments that offer tax benefits. So I was quite happy with that. It's the first time I'm doing it, and I've been educating myself over the past year or so, and it's starting to pay off. So that was nice.
That's great, Emily. Thanks for sharing. I can't see the chat. I think we're feeling shy. Would anyone else like to share anything? Maybe something less positive too. Maybe something you've been thinking about lately in relation to your financial journey. Ajit, I have managed to save the most that I have ever saved in the last year. Congratulations.
Yeah, just relating to Ajit's point, I think it was off the back of another one of the financial wellbeing sessions that we had done earlier in the year. I actually went to the bank and had a discussion about some of the savings accounts I had. It was one of those things that the money was just sat there and it wasn't really doing an awful lot for me. So talking about, how to potentially invest it and having it in an account that will work better for me. So, I mean, it's not positive or negative. The money hasn't changed, but just thinking about it, I feel like is a small step in the right direction for me.
Were you inspired by one of our sessions, Katie?
Yeah, absolutely.
Excellent. This is exactly what we want to be doing. Wonderful.
That's brilliant. And actually you said it's not positive or negative, but you said it's having a positive effect on how you feel about it, and hopefully fueling you to continue on that positive progress. And Crystal, so thank you for sharing, Katie. And Crystal, she's on track. You're on track to pay off a credit card this year. Well done. Congratulations too. And also Elle, who is Elle? Daliwal. I don't know what's your first name.
Loved it.
I loved it. Oh, hello, Loved it. thank you for sharing inflationary pressures and your impact on investment. Is this something you would like to focus on, or your concerns? Yes, I get that. Okay. Inflation concerns from Sean too. Okay, great. Funto, I've always been able to save more. I'm closer to getting a deposit for a house. Beautiful. That's amazing, Punto. Sean, man, you the best time to invest in 10 years will arrive soon. Or it could be now. Who knows, Sean? Okay, great. Thanks very much all for sharing. I'll close the chat window and let's move to, yeah, that's a perfect slide. So how do finances of women and men measure up? I mean, everyone's lives and goals are different, but there are moments in life that many people experience regardless of our gender or who we are, such as starting work, marrying, having a child, retiring, or losing a partner. And various scenarios at each stage can affect your wealth and ability to reach your goals. So it's important to work out how you can shape your wealth to cope with the challenges and to achieve your ambitions. So back in 2017, UBS did a research into key differences in the way in the wealth journey of women and men, and we looked at the pay gap, career break, flexible employment, life expectancy, and risk tolerance. And we estimated how these differences affect men, how these can affect men and women, how did it affect their wealth. And here's what we have discovered. If you could move to the next slide, Katie. We found that these 5 factors have accumulated together and could lead, depressingly, to women being unable to meet their financial needs in later stages of their lives. So this chart shows these estimations. So if you start with 1, comparing to your average Joe, the pay gap is the gray area, is how much it could affect your assets over the long term. 2 is how much your career break could affect you. Then 3 in dark gray, flexible employment, so coming back after a career break and perhaps taking on flexible employment or lower paid role. 4, our supposedly lower risk tolerance, and 5, longer life expectancy. And so as this accumulates, it does provide a bit of a scary picture. But all is not lost, because there's a big part of this chart that each of us can take control of today.
Ola, sorry, before
Sure.
you move on, so the number 5, the life expectancy, it looks like is it the biggest factor? Am I reading the chart wrong? Which one is the factor that is the most detrimental?
In terms of
3?
It's the number 3, flexible employment,
okay.
that has the widest span.
Yeah.
It's on this chart. It is interestingly, well, the way it's been portrayed is the risk tolerance that could take you over.
Yeah.
And also what I would like to highlight is that it's the risk tolerance that we have control over, and can look to, I guess, improve the picture if we approach it from the right place. And it's never too late to. A lot of you are investing already. Thank you. I've seen it in the results of the survey. Some of you aren't, and it's never too late to start investing, and it's never too late to reassess your risk tolerance, your risk profile, and your investment strategy. So, and this session is the time to take action. Hopefully, we'll provide some encouragement to do that. Perhaps how are we doing for time? Very quickly, I would like to also mention a few things about financial confidence that I've seen in research. So did you know that financial confidence can be associated with risk tolerance, which in turn depends on risk perception? And recent research has confirmed that greater familiarity with risk is associated with reduced risk perception. So this suggests that the more experience we have with investing, the more our risk aversion should be reduced. So basically, the more we do it, the more risk averse we feel, or the more confident we feel about taking risk. And also, knowledge increases risk tolerance. Most likely, it affects the perception of risk. So this really relates to how women tend to think about investments as well, because there's this perception that women tend to be more risk averse. But this research that we found paints a picture that if we as women feel that we know more about investments, whether when we're investing on our own or whether we're working with financial advisors, then we're willing to take more risk, or we're comfortable taking more risk. Also, men tend to be more exposed to investment conversations in their early lives, and this is an opportunity for us to have these conversations as well. And the other research that I've seen is that women are willing to take more risk when investments they are considering are linked to their values, are reflecting their values. So interestingly, when we think about ESG investing, we've seen that women are open to taking more risk there. So we are being moved along. So perhaps we could look very quickly at some of the results of the survey. I can't screen share while the other participants are sharing. Okay, let's share now. And thank you once again for completing it. And I'm sure you'll be interested to hear or to see how your answers compare to others. So the first question, very quickly, where are you on your investment journey out of the 19 participants? Very pleasing to see that all of us have some sort of savings, and the majority of us have an investment account, ISA pension, and employ a financial advisor to help us invest on our behalf. And a number of us also invest on our own, and a few, 16% of us have savings, but most of them are in cash. So my hope is that you would like to begin investing. Interestingly, on the goals that we resonate with most, the majority of us would like to have a comfortable retirement and also maintain lifestyle or create financial security for a rainy day. Just over 1/3 of us would like to buy a house or large price tag item, or you would like to empower your money to do good in the world, which resonates with the aspect of investing according to your values. We had some texts as well, so to be independently wealthy, and also child support and educational has come up. So I think the message from this is that, again, we are, all of us are, every single one of us is an individual, and we have different needs. But essentially, in terms of what we want in the future, and now we want financial security, comfortable retirement, perhaps large price item, and also providing for our children. The financial journey that I described and the chart that I shown with how we are affected by different factors, we feel that most of us feel that we are affected by pay gap and interestingly, by conservative or overly cautious risk profile as well. So I'm glad to say that, as I mentioned, the risk profile is something that we can definitely affect. Perhaps pay gap too, if we employ E2W to find us great opportunities with as low pay gap or no pay gap as possible. Very quickly whizzing through, this is an interesting one, and perhaps that might be one of the last ones I will show you. So how willing are you feeling or able to lose money in exchange for the chance of growing it? And so you can see most of us have a moderate or very or low loss aversion. So we are willing to take risk, we're keen to receive returns and don't mind if there are bumps along the road. 10% of us had said that we have a high loss aversion and would rather avoid investments that could lose modest amounts of money if they might deliver big returns. So that's definitely, I think, an element of an educational piece, and perhaps that confidence, as I alluded to, the fact that it could be linked to knowledge, and yeah.
Yeah, well, I was going to say the fact that so few of us have said that we had a low risk aversion is probably a reflection of our peer group, and most of us work in financial services, so we're probably a bit more inclined to take risk that way, but it's probably not the case for the majority of women who may have a much higher loss aversion. I've definitely seen that in my social circles outside financial services. So we're in a very privileged situation where we understand financial services and we understand that the concept of risk reward, but this might not be the case when we broaden up our circles.
Yes, that's a very good point, Amelie, and I think that's why it's quite important to be changing the conversation around risks away from risk of volatility of investments going up and down, and perhaps more towards a focus on risk of not being able to meet our long-term financial objectives. And hopefully, psychologically or mentally, that can change our perceptions of as I said, of risk, but also focus focus our minds on what's really important, and that we have to be making decisions and steps towards saving or investing for the future.
That's a really interesting way of reframing the conversation. And I had never heard that before. Risk of not meeting your goals. And is that how you approach it when you have clients who have a higher loss aversion? Do you sort of reframe the conversation around risk? And do you find that reframing it that way helps with them and their risk tolerance?
Yes, very much so. So that's a really good question. So when I talk with my clients about risk, we divide risk into 3 categories. So one is their attitude to risk. So how comfortable they feel about seeing fluctuations in their investments. Naturally, as humans, we tend to focus on the down risk. But so yeah, how comfortable they would feel seeing their portfolio, fall in value by 30-20%. 2 is how much risk they need to take to meet their objectives, and that's the reframe of that conversation in terms of, okay, maybe you are very cautious, but you hope to be able to have comfortable retirement in the future. How much income do you think you might need in the future on retirement, and how much risk do you need to take, or how much does your portfolio need to grow by to achieve that? So yes, that's one element. And the third one is it's linked to it. So it's how much risk can you take? So how much loss can you withstand? So if we think about some of the answers we've seen, that most of us want to have a comfortable retirement, and also element of security. If we're thinking of a long term, if we don't depend on these assets, on this pot of money for your current income, then the overall idea would be that you might be able to withstand more risk or more loss in the short term. So these are the three elements. So your risk attitude, your risk of not meeting your objectives, and your ability to withstand loss. Does that make sense? Great.
Thank you.
I think I'm going to leave the survey at that. I would be very happy to find a way to share it with the attendees post the event. In the interest of time, I'll switch it off and let's focus on the investment refresher. Let's stop sharing. Great. So would you mind sharing again, Katie? Thank you very much for being my operator. So very quickly, financial confidence. I think there is this idea when we think about investing that we have to know, when I say we, I'm generalizing about women, and that's how I felt personally when I was coming into investing, is that we have to know everything there is to know about investments, about markets, which can make it psychologically quite difficult to make that first step. And so I wanted to include this slide to, again, enlarge what we're looking at when we think about financial well-being and financial confidence. And that is that the expertise, the knowledge is just one element of it. The other one is you understanding and knowing what your finances are, what your goals are, what your beliefs are, and what actions you need to take to meet your long-term objectives. And the third one is trust, and that's, you don't always have to make all investment decisions yourself. It does pay sometimes to speak to a financial advisor and trust that they have your best interests at heart. They are regulated. Naturally, there are some worse and some better advisors, but overarching idea is that they're highly regulated, and it might be worth having a conversation with one of them to get you started. So moving to the refresher and what to invest. And perhaps I should start as well. Apologies if any of it is patronizing, and if it's it's something that you're very familiar with. I might go to quite basic definitions as well if we have the time. So when you would invest, as you know, we would put our money into assets, which has different potential risk and rewards. And as we are investing, you may have come across the term asset classes, and that's very much a group of investments that are similar to each other and behave in similar ways. And when you look at this chart, naturally, as you move from left to right, the estimated risk of these asset classes increases, and equally, as you move from the bottom up, the estimated returns also increase. So we're starting with cash and fixed income. Hedge funds sit somewhere in between fixed income and equities. And then around there, you have private equity, real estate, and commodities. Would it be helpful if I went into basic definitions of these asset classes? I'm not sure, I can't see.
Put your hand up if you need a refresher on those, maybe.
I can't see everyone. Let's see. Yes, thank you. Okay, very quick refresher. So liquid assets, cash, that's there for you to access immediately, or if you place it on a fixed term deposit, it might be within a limited time. They're generally considered safest investment. However, as we have mentioned, inflation currently is quite high and can eat into the real value of cash. And that's why it's important to look at other ways of holding your savings. Fixed income are investments that are a type of a loan that pay you interest on a periodic basis. And yes, exactly, Sean. Yes, 100 today, 90 tomorrow for cash, sadly. So fixed income, yes, they will pay you periodic interest and then repay your original investment amount, or repay fixed investment amount in the future. Bonds are your cash is wasting asset, but does give people the Mars bar feeling. Yes, it does feel like a secure way of holding wealth, despite the fact that inflation can eat into it. So bonds are most common types of fixed income. You would generally lend your money to a private company or government organization. And the idea is that on a future date, on maturity, the bond will provide you with its value and pay you that fixed or variable interest payment.
Just a little caveat on fixed income, and just because my job title is
fixed income
investment.
Yeah.
My job title is fixed income investment specialist. I'm just going to jump in. When you invest into fixed income assets, you will invest through funds, so it will be highly diversified. You will not be lending your money to the US government directly. It will be highly diversified through hundreds of companies and hundreds of governments. But one caveat I would say is that, yeah, it sounds secure because you're getting the income, and then at the end of the maturity, the notional, the principal is repaid to you. There's two things that you need to bear in mind, is that these are highly exposed to interest rate rises. So at the moment, fixed income is having a horrible time because interest rates are rising. So the market is repricing the value of fixed income assets. So whilst they're low risk over the long run, you can have some shockers if you're in an environment which is high inflation and interest rate rising, which is what we're experiencing at the moment. I just want to caveat that because everyone at work is challenging me on this fact, and I thought it was quite interesting to see the market dynamic. And I will stop right there.
That's great. Thanks very much, Amelie. And bearing in mind that how that fixed income can be still volatile and is your interest could be affected by inflation, a point in time will come, most probably, once interest rates are, get to base interest rates get to, let's say, 3-4%, where it will become it could become an attractive investment again. But so far, up to around now, as interest rates have been so low, it has definitely not been a risk-free investment, if that makes sense. Equities can also be called stocks and shares. There are just little bits, chunks of individual company you might be investing in. And coming back to Amelie's point, we might be invested in equities directly in stocks and shares, or through pooled investment funds where we delegate the management of our chunk of investment to an investment professional, a fund manager. Commodities, I think we all know what they are. Private equity, perhaps one worth mentioning, they tend to be actively managed. If it's a fund and illiquid, it's possible to invest in private assets through other types of investments, such schemes such as EIS and VCT, and perhaps that's a conversation for another session. But here with illiquid assets, you are receiving or expecting a premium return for the fact that you tend to invest in higher risk companies, and where your capital is locked away for longer periods of time. Diversification. If we move to the next slide, please. So why it's important to diversify? It's important to diversify because historically, no single asset class has performed consistently over the long better than others. And this table illustrates that neither individual investments nor in the indices, market-related indices, do. If we were to follow, I think it's the light orange, so commodity index in the last 6 years, you'll find that since 2016, commodities have been one of the top performers for 3 years and bottom performers for 3 years. So it's definitely very difficult to pinpoint which type of asset will do well always. And having a diverse investment portfolio is like packing a suitcase in for a British summer, I think, summer holiday. It will probably rain, so we need a thick jumper and a raincoat, but the sun might shine. So you'd want to have a t-shirt and some shorts. And financial markets can change like the British summer, sadly. And that's why it's wise to have loads of different investments that react differently to changes in those markets. And you can reduce risk within your portfolio by because different specific companies, different specific sectors, industries, and geographies might behave differently. So the idea is that you choose investments with values that typically don't move alongside each other. So
in terms of risk profile return, actually, so it's now commonplace for asset management companies which are providing these types of investments. So we provide funds that you can invest in as opposed to individual stocks. There's always a risk indicator. So I think it goes from 1 to 7, 1 being the lowest risk, 7 being the highest risk. So when you're thinking about investing into a fund, you can look at what is called the KID or KIID, which is a useful 1 or 2 pager explaining what the fund does, the risk return profile, historical returns, and what it's investing into. So if you're not sure, just have a look at that document. It also shows you the management fees, so how much the asset management company is paying themselves to have the privilege of running this money. So you've got some types of investments which are low fees, and some of them which are really high, like 1%. So those fees are important because they eat away from your return over the long run. But if you're not sure what you're investing into, I would highly recommend that before you pull the trigger, look at the KID, KIID.
Yeah, key investor document.
Yeah, something like that.
Or something along the line, or KID or KIID, absolutely. And you know, great that you alluded to funds again, Amelie, because you know, no matter, you can start with as little as £100 if you want to invest, and funds provide a really great way to do that. You can even, you can choose your own funds once you've decided how much you might want to invest in equities, perhaps some in bonds if that works for you, and then again there are funds that offer a broad global strategy, and also you could be divided if you feel like have more time and would like to make your own calls in terms of how much you would like to allocate to the UK, the US, different geographies. There are funds that look at this individually, and you could make your own division, and you can go even more granular if you wish. But ultimately, there is nothing wrong with starting with if you're just beginning the investment journey, there's nothing wrong with starting with a broad-based fund or a tracker that can provide you with diversification as a starting point.
Your point on geography is really important, Ula, because there's always a home bias. When I speak to French people, all they're investing into is French companies. When I speak to some British people, all they're investing into is British companies, and I think it's sort of damaging to keep the home bias because
don't forget that countries have, you know, the cross-border. Got some cross-border things to remember. I just have to jump in there. I've been reasonably quiet, but British people of a certain age will invest in British AIM companies because of the tax relief you get by investing in an AIM IHT portfolio.
okay.
So actually it has advantages, taxation advantages for people of Mark's age and my age to invest into small cap or AIM listed British companies.
That's fair. No, definitely there are schemes in place. It's important to caveat that. But when I speak to my in-laws in India, all they want to get exposure to is Indian assets. And I keep telling them you need to diversify, because if, say, you work for a British company or you work in the UK, if there is a recession, your job may be at risk. And
absolutely.
your company may be at risk.
Quite agree.
And the last thing you want is your portfolio to be at risk as well. So global diversification is generally a good thing to think about.
Well, yeah,
all else equal.
The markets are where they are. And sadly, the way markets are at the moment is that retirees, not only could they get, or as you're approaching retirement, not only did retirees get smashed on that they didn't get anything for savings when interest rates were so low, and we wait till the bated breath for 2 o'clock to see what the Fed are going to do. But global diversification is the answer. And, you know, being ex UBS myself, I absolutely get the whole diversification mantra. But in terms of taxation and going towards drawdown, you do need to be aware that actually it's advantageous because you've got to drop 40% on your AIM portfolio to actually be down on the tax that you're going to save as long as you don't die for 2 years. Yeah. So that's I would just throw that one.
That's really helpful. Yeah,
I didn't know that. I need to speak to you, Sean, because I'm looking for tax advantage. So it's important to
tax advantage. Sure. And actually, I have to say, I do it myself, and I dare say Mark probably is, because he's quite savvy at things like this. He's, you know, the classic thing is just don't die for 2 years, and the money sits outside your estate for taxation purposes. And right now, I do think in the summer, you know, because British assets, in particular British assets, are bloody cheap and are getting a bit cheaper, but then it'll get to that key point when it's time to, if there is the 5,000, 10,000, 20,000, it's a time to put it in there. And actually for Gen Zers, which many of you are on the call, or in some cases Gen A, Gen B, having you can afford to take a little bit more risk because you've got a longer time horizon, as you've seen on the risk return profile. You can afford to take a little bit more risk because actually you can ride the sine wave of the ups and downs. But bizarrely, and I'll shut up now, Mark, because Mark's giving me the electronic eye. Is I actually had a group of a millennial, because so that's what they're now 34, 35 roughly. Fund managers come to me and say they'd never seen markets or anything for investment like this ever before. It made me realize, wow, yes, you were at school when people like Mark and I were like, watching the screens go red in 08, and they stayed red for a very long time in 08. And we've got so many external factors at the moment that actually, for people with a longer time horizon, and I think what you're saying and Emily's saying is, now is the time for all of you, particularly professional women, to think about, I have a longer time horizon. I can't guarantee my partner's going to have anything or not, or you may want to stay on your own, but actually now could be a really good time, and we might not see this again, hopefully, fingers crossed, for 20 years. So people really need to be thinking about this right now with financial advice. Thank you. I'll shut up now, Mark. Sorry.
That was brilliant. Thank you so much, Sean.
Thanks, Sean. Yeah, absolutely. And as we said, it's important to diversify across geographies, different markets. The UK market is doing okay this year, better than others. But over the long term, it's important to diversify globally, because the growth potential from technology progression, can be accessed less so in the UK, but more so abroad. So very important to be diversifying across asset classes, geographies, styles, and so on. Where were we? So I think I'm going to skip through this. What about risk? I was going to just mention a few mistakes worth avoiding, and actually one of them Emily has very helpfully mentioned, and that's staying too close to home and home bias. Naturally, we feel more comfortable investing in our home market, but it's definitely very important to consider accessing investment opportunities outside. If we're in the UK, outside of the UK, if you were invested in the FTSE 100 index in the last 10-15 years, you would have been well behind what the S&P, the US stock market, has done. But year to date, the FTSE is, I think, just below or just down, whereas the S&P is down about 20%. So again, importance of diversification, but also of trying not to stay too close to home. Thanks, Sean. So, the other mistake to avoid is changing your investments too often. I'm alluding to market timing, and we say it's about time in the market and not timing the market. And Sean as well mentioned the fact that we are relatively young, we have long-term investment horizons, and if we bear that in mind, the idea of going into the market, investing some of your cash for the long term and allowing compounding to take its course should help you. Keeping that in mind should help you stop from should help you, perhaps mentally stop from needing to change your investments too often. Other people cannot market time either. No one can market time.
No, and it's interesting. I've seen some really interesting research a few years ago showing that women who invest actually generate better returns than men. But mind you, it was probably 5 years ago, because men tend to be a bit overconfident and they're constantly reshuffling their portfolios and generating very high trading costs. So it might be that they're securing marginally better outcomes by, trying to time the market, but they're generating more trading costs, which kind of offset that. So from that perspective, it's important to know the cost of reshuffling your investments too often. So I think point number one is super important. But generally, women tend to be quite good at it, if I overgeneralize.
I've seen those stats as well, and I felt they provide comfort to me to feel that, okay, yes, perhaps we do take a bit longer, we do want more information before we go into that investment, but it also means that we're willing to stay longer, invested for longer, and it does pay off. Second point is not checking and maintaining your portfolio regularly, and that's not to say that you should be changing your whole portfolio regularly, but really just to keeping an eye on perhaps some positions that have drifted up too much or down, and considering rebalancing it so that it stays in line with your overall risk profile, and your objectives. Letting big numbers blind you and obsession with alpha, so with excess returns. I think some people choose star fund managers and investments because they're impressed with how they performed recently. So I guess the message is to not just purely look at past performance and not be blinded by it, because what goes up can come down. It does complicate the idea of choosing investments, because we can't just purely use past performance, but it's helpful to use other indicators alongside performance track record. Sticking with losers, not winners. So this bias towards hoping, I guess the hope that those losing positions might come back actually sometimes it does pay to just cut our losses and look for other better investment opportunities. And the fifth we have mentioned already. I have been talking for a long time, and I wonder whether you ladies and gentlemen have any more comments on those mistakes, or any other aspect. I haven't given you a lot of time to jump in.
It's almost as though you want people to print that off and stick that on a wall somewhere or in their notebook or something like that, because very good indeed. Thank you.
Pleasure. Can you
Hello. Could I just ask a question, please? It's just about really how to educate yourself about choosing these winners and losers. You know, where would you get the education to be able to do this yourself?
That's Tina, isn't it? That's a very good question. That's a very good question, especially as I'm saying that you shouldn't just be using past performance. I think some of the rating companies are quite useful to look at. None of them are perfect, but Morningstar, Hargreaves Lansdown have some really helpful research. We found as well some research that women really do well when investing on a collaboratory basis. So, you know, it's nothing to say that you can form a circle and do some research jointly with other women as well. That was part of the hackathon that I've done, that we found that, you know, we like sharing ideas. We actually often have quite a lot of knowledge already, and just also bouncing it off our contacts and just helping on that front. Do other guests have ideas of how they might be looking to educate themselves?
Can I ask a question of everybody? Just some of our clients who operate in the wealth space are very keen to employ and get more female advisors on board. People like Ula. Are you happy or happier? Would you be more inclined to work with a female wealth manager advisor than a male one?
That's a good question.
That's a very good question, actually, because there are some stats, and I'll wait until the answer and tell you what the stats are, which is weird.
I can jump in if none of the guests have comments.
I have the feeling that men don't like female financial advisors. Sorry. I think that's my gut feeling.
But do women like male ones, or do women prefer female ones?
It's a hard one. I think it could be 50-50.
Is that what you're pitching at, Emily? Is it you're pitching 50-50?
I think 50-50, like women's preferences in terms of male or female advisor. It's a bit like choosing a gynae. Some women prefer male, some women prefer female. Sorry, just
from the Diversity Project. The not that I think there's exactly as Mark said. The problem is there aren't enough female advisors and investment managers. Simple as that. So that's going to skew the stat anyway. And I actually think we're incredibly poor as an industry for pushing female talent, but that's whole nother conversation. But in terms of choice, believe it, actually 65% of my clients are women, because they want to see an old dude generally, but that may be because they don't have any choice. You know, it's like they might not have any choice. I think that drives the stats, but you know, it's generally they want a bit of, and the other thing that I particularly always make out is that sadly some of my male colleagues can be quite condescending to the wives of very successful entrepreneurs that we bring in, whereas actually, I don't know whether it's because I was brought up by my mother. I was like, nah, don't bother with the bloke. He makes money, right? But I'm going to talk to the wife or the partner. In particular, we're talking male female situations, or indeed, I've got a couple of same-sex partner clients, and actually work out the one that's in charge. But it doesn't matter whether they're the one working or not, because they pull the strings.
Yeah.
That's very important.
Brie, you had a comment there.
Yeah, I'll have to drop off in a minute, but I heard from female clients who specifically expressly said that they prefer to work with women, and that's because they feel that they can be much more open about their insecurities, but also just in the conversation they feel that they're coming at it at a level ground, whereas and it's not not all male advisors are this way, but they can be a bit more patronizing, and I think the conversation then doesn't feel as level up, if that makes sense.
Britt, sorry, I'm good to bring you in because you had a comment there which I just caught in the chat.
Yeah, just for me, it's a little bit more complicated because I have both US investments being American and then UK investments being UK citizen, and the dual citizenship that comes in, and trying to find someone that covers all of that in terms of the tax. And I have some people here that don't know US tax rules, and they'll say something, I'll be like, okay, I actually know that that's not really tax beneficial. So sometimes I found I might know more because of the tax implications on the US side. So finding someone who's both has been difficult, because I do like working with women on investments because they seem to be a little bit more receptive to spending the time.
Brilliant, thank you. I'm just sorry, you've just seen Ula, amazing. Thank you very much. You're a star. And I know you've got to drop off for 1 o'clock, so we will let you go. Thank you. Sorry, Emily, to finish off for you.
No, that's okay. Well, we're approaching 1 o'clock, so this was kind of a taster session, just a refresher, but we're looking for cues from the audience, so as to what you would be interested in. So one of the next session which I've been thinking about is tax efficient investments. So VCTs, EIS, venture capital trust, EIS. We've got a lady from E2W who's brilliant with that. So that's more sophisticated, that's more tax efficient. So we're looking to do that. But if there's a specific topic you would like us to explore, please reach out to me. You'll find me on LinkedIn, on the WhatsApp chats, on E2W, on the member portal. Please reach out. I'm passionate about this, so I love having those conversations. And I could go on for a long time, but it's 1 o'clock. So I just want to say thank you everyone for joining us today. We hope that was useful. And when we can continue having those sessions and just improve our knowledge and financial well-being.
Thank you so much.
Yeah, brilliant.
Thank you.
Absolutely.